Muy buenas tardes, mi nombre es Deicy Ángel, trabajo con Coast Country Mortgage y hoy les estaré haciendo la presentación en inglés. So good afternoon, my name is Deicy Angel and today I'm going to be doing the presentation in English. My coworker Diana, she did the presentation earlier today. It's going to be the same information. We're going to be talking about FHA and conventional. So we're going to be talking about a lot of details in between those, and then we're going to give you at the end, we're going to give you some tips on being able to be in touch with the main clients or sources where you can get a lot of clients from or referrals from. So we're going to start, like I said, talking about FHA and conventional. Wait 1 second. Okay, so here are the two different columns. The first one is the main one, which is FHA, which is here in Florida. A lot of primary or first home buyers are more interested, or actually is the one that is more known. And then on the other hand, it's the conventional loan. There are two different programs, different guidelines, different similar documentation, but it's not all the way the same. So the first one is FHA, like I mentioned, which is Federal Housing Administration. That's what it stands for. And then conventional, which is Fannie Mae and Freddie Mac. What are the difference? So on FHA, the government is the one that insures the loan. Those are the ones that actually provide insurance in case that the person who obtains the loan defaults in not making the payments. Then the lender can communicate with FHA, and then they insure the loan in case, again, the borrower defaults in not making the payments. So that way they don't lose all the money. And then conventional, it's Fannie Mae and Freddie Mac. Okay, so Fannie Mae and Freddie Mac, those are semi-governmental institutions, and those are the ones that insure the loan compared to FHA's Federal Housing Administration. So Fannie and Freddie Mac, they have their own guidelines, their own requirements. They're not the same as FHA. So this one we had hot on FHA, which is a website where we can go into, and I believe last time we gave the little links where we can actually go into the link and see the different documentation that we need. And then conventional, also they have their own. So Fannie Mae has their own, and Freddie Mac have their own. So sometimes it varies, not too much as compared to FHA, but they do vary a little bit. They even have their own platform where we have to run the findings through. So example, Freddie Mac, it's LP, and then Fannie Mae, it's DU. It's a different platform. Then the second item that we put here, which are the difference between FHA and conventional, is that for FHA, only the person that is buying the property can only obtain it as a primary property. That's only for primary. So the borrower must occupy the property after closing. It cannot be an investment property. It cannot be a second home. It must be a primary property. And then conventional, they have, you can actually occupy the property just like FHA, but you also can buy the property as a second home, which means that you're gonna be living part of, during the year you're gonna go and visit, or you can have it for your family to go and visit, just like a vacation house. And then also you can buy a conventional, not buy, but you can apply for a conventional loan if you're buying an investment property. So let's say, for example, a borrower comes in and they tell us, okay, we're gonna be doing an investment property. We already know FHA is not for them, because FHA is just one simple one, which is primary. That's it. They cannot buy second home or investment property. Conventional has different options that you can do the loan, which is primary, second home, and investment property. In regards to the down payment, FHA, because it's FHA, the government is actually the ones that insures the loan. They're very, how do I say this? They're very flexible. So the down payment is usually less than the conventional loan, which is 3.5%. You can put more than that. You're actually welcome to do it. But the minimum required down payment for FHA that the borrower must bring at closing is going to be 3.5 of the purchase price. Of course, you're going to add the closing costs and you're going to add the prepays. That's just the down payment. Now, on conventional, the standard one usually is 5% down when you're going to do a primary home. Now, if you're going to still do a primary home and you haven't owned a property in the last 3 years, you might be able to still get the conventional loan, but instead of the 5%, you can put 3%. But it goes case by case, but we have done it, and it is available too. And that's just, again, minimum down payment. You can still put more, but you're required to put between 3 to 5%. Remember, on conventional, you can also buy a second home, which is the one that you can go in and use it when you're gonna, let's say you live in Texas and you're gonna come here and stay there, but you're not gonna rent it. You can do that. But on second homes, you have to have at least 10% down, plus the closing costs and prepaids, depending on the house that you're gonna buy and stuff like that, and the title company, so it changes, but we're talking just about down payment. And for investment properties, the down payment on conventional, because that's the one that we're going to be talking, remember FHA doesn't do investment properties, it's 15% down. But remember, if you put less than 20% down, you're going to have a mortgage insurance. So even though the minimum down payment required on an investment property is 15%, you're going to have a mortgage insurance, and the interest rates are a little bit higher. If you put 20%, the interest rates are a little bit lower and more favorable, and you don't have to pay mortgage insurance. So it depends if the borrower has the money, or if they want to use it to put the 5% more down to be at 20% down. I recommend that. But if not, they can still put 50% down, and that program is available for investments. As far as the credit scores, FHA, remember, it's a government. They're more, they're not as strict as conventional loans. So the credit score for FHA starts at 580. The higher the credit score, the better it is, because the terms of the loan are going to be more favorable as far as the interest rate goes. For conventional loans, it's 620. Now, if you have, sometimes I come across when I have a borrower and they're applying for a loan, and their interest rate is 620, which they qualify for a conventional loan. But when I compare it between FHA and conventional, the interest rate is actually better if they go. It just depends. So the higher the credit score, the better interest is for them. The interest rate goes. So we have to compare case by case to see which program is best for the borrower when they're buying a primary home, because if they're buying an investment property, they cannot go FHA. That's very important. In case that you have any questions, you can put the information on the website, and then I'll answer that for you. Do you have any questions here so far? No? If you have any questions, just let me know, and I'll address that. Thank you. So that's the credit score. Remember, the higher the credit score, the better it is. Sometimes what we can do, we have a program in our end, which is called What If Stimulator, which is a program which allows us to see what can be done to increase the borrower's credit score, which helps them at the end for the credit score, or maybe they have too low, their credit score, it's below, let's say 580, then we know what they need to do in order to increase it. And then we'll provide that to the borrower. They have to do what they need to do, and then we'll have to contact the credit company, and then they'll do a rescore to make sure that the credit score go up. As far as the interest rate goes, for FHA, the interest rates are usually lower than conventional loans. So if we have a borrower that is 600 credit score and their debt to income ratio, which is the calculation between their income and all their debts, it's actually high. It's more and they're buying a primary home, it's more likely that we're going to go with FHA than conventional loan, because the terms, maybe they don't qualify. So usually when a person qualifies for a conventional loan, they can actually go FHA if they want. But sometimes the borrower only qualifies for FHA because of the credit score, or because the income, the debt to income ratio is too tight, which they don't go into the parameters that goes to a conventional loan. So if a borrower qualifies for a conventional, they can most likely go into an FHA if they're buying a primary, but sometimes only the borrower qualifies for an FHA loan and they cannot go conventional. Another big difference between the FHA and conventional, very important, is the insurance that they have to pay. So for FHA, which is the one that we're talking initially, or primary, it's there's going to be two MI, or two mortgage insurance that are in there, and one of them, which is the upfront mortgage insurance, it can be paid as the word says upfront, which they can pay at closing. Or if the borrower wants to not pay it, they can finance it. So what would happen is that if the lending, let's say 80,000, which is very low, 80,000, and then the mortgage insurance is 2,000, then the loan amount is gonna be 82,000, and that's gonna be paid during the remaining or the life of the loan. So again, you can pay the 2,000 at closing, or you can add it to the loan amount and not have to bring the 2,000 at closing. That's the main one. So that's one of the insurance that FHA, or Federal Housing Administration, actually requires a borrower to pay if they're gonna be using the FHA program. The other one, which is the one that gets paid monthly, there's another one, and that varies depending on how much down payment they're putting. That's the mortgage insurance. So let's say we have a borrower, they're buying a primary property, they're putting only the minimum, which is 3.5% down. That mortgage insurance is gonna stay in there. The borrower has to pay that every month until the loan is paid off, either because the borrower sold the house or because they refinance, but they're gonna pay it during the whole time of the loan, or life of the loan. However, if they're gonna be putting more than 10% down, then that mortgage insurance is not gonna be paid during the 30 years, 15 years. Instead, it's gonna be canceled at 11 years. Unless the borrower decides that they wanna refinance before, and then depending on the new terms, then that's something different. But for that FHA loan, that specific FHA primary, and if they're putting 3.5% down, the mortgage insurance is gonna has to be paid every single month, and it's gonna be included with your mortgage payment. It cannot be paid separate. It's gonna be in there. So you're gonna see your mortgage statement, and you're gonna see a breakdown of everything that you paid every month, and that's gonna be one of them. For conventional loan, there's gonna be only one mortgage insurance. So remember, on the FHA, you have the upfront and then the one that you paid every month. On the conventional, you only have one. Depending, if you put less than 20%, you only pay one. So if you put, again, less than 20% down, you're going to have a monthly mortgage insurance, which is a private, and that's not going to be backed up by FHA. Instead, it's going to be by private mortgage insurance companies. There are different ones, and each one has their own quote depending on each borrower, depending on the property, depending on the type of the property, depending on their credit score, depending on the LTV. Each one has their own quote that they provide us. And then we'll decide which one is the lowest, and we'll go with that one for the borrower. And that's also paid within the mortgage payment every month. Once the borrower pays, let's say they only owe 80% of the value of the house, and let's say they only bought the house a year ago or 2 years ago. 2 years ago, they bought the house, they put 10% down, they have to put, the lender is gonna require a private mortgage insurance to be collected. And within 2 years, if the value of the house increases and the borrower thinks that they have enough equity where they can cancel the mortgage insurance, the borrower must contact the lender who is actually servicing that loan at that time, and they can request to cancel the private mortgage insurance, which can be done, but most likely the lender is going to require a inspection, and they probably charge $500, $600, and it's a little paperwork that it needs to be. Probably you can do that in less than 2 months for sure. There's going to be an investor that goes in there, and if everything looks good, they can go ahead and cancel that private mortgage insurance. On FHA, you cannot do that, only on conventional loans. On FHA, you have to be for the life of the loan, or if you put 10% down, then it gets canceled at 11 years. The next item are going to be gift funds, comparing the gift funds between FHA and conventional. So for FHA, you can put, everything can be a gift fund. So closing costs, prepaids, the down payment, everything can be from a gift. Who can give you a gift? Your spouse, if your spouse is not on the loan, because maybe they don't have income, or maybe they don't have credit, or maybe they just don't want to be on the loan because they don't want that loan to be reflected on their credit report. So it can be your spouse, it can be your dad, it can be your mom. It has to be very close. His relatives are very close. Now for conventional, it varies on the type of loan that you're gonna be buying. So if it's a primary, it's similar to FHA. However, when it goes to a second home on an investment property, it varies depending on the down payment that you're putting. So it's not the same. Now we're gonna be talking about the DTI. The DTI is super important. That's debt to income ratio. Debt to income ratio. That means that it's a calculation that we do based on the borrower's credit report, showing all the monthly debts that they have in there. It can be a car loan, it can be a student loan, it can be, maybe they have another mortgage. Anything that is on their credit report, it's included as part of the debt, monthly debt. We don't look at the balance or how much you own on the car loan. We don't really care about that. We care about how much you have to pay every month. Of course, it's not just the credit report, because maybe you have child support, you have alimony, and that's not on the credit report. That's part of your monthly debts. What we don't include, it's the cell phone bill, light bill, water bill. That's not included into that in that calculation. So on FHA, the debt to income ratio, it's more flexible. So the government allows the buyers to have a higher debt compared to conventional. So usually it's 56%, and it's similar to VA. VA, it's it's a government loan too for veterans, and the debt to income ratio compared to conventional is way higher than conventional. Now on conventional, it varies. So this is just general. This is not as specific and everything is gonna be the same, every client is gonna be the same. No, it's not like that. This is just to give you some information, but every client, it's different because the credit score actually, the credit history, not just the credit score, but the credit history, if they have collections, if they have a bankruptcy, a lot of things affect that. So we do have to run the file through our system, depending on what program it is. If it's FHA, we run it to DU, conventional DU, or LP. We have to run it through the system to make sure it gets approved. But in general, the debt to income ratio for conventional is 49.9. Of course, sometimes I've seen where it can only be 30% debt to income ratio, which is way low. And that's again because of the credit history. Maybe they have late payments, or there's something that the system doesn't really like, or the LTV, it's too high. Or maybe reserves. Once you put reserves, I've seen it when it goes from a refer and eligible to an approved eligible. So a lot of things are taken in considerations. It is the one that actually tells if it's approved or not. Now we're going to be talking about seller's contributions. For FHA, what are the seller's contributions first? Those are the fees that the seller or maybe the realtor wants to give the buyer as part of the closing costs and prepaids that they can actually use to be able to purchase the house. We don't see that right now a lot because of the market, but we've seen it during, the time. Maybe this is going to change later and we're going to be seeing that later on. We don't know yet. I don't know. But those are the seller's contributions, or the contributions in general. So each program has the limit, and FHA is going to be 6%. Now, conventional is changes, and it also depends on the down payment that the borrower is doing. So for example, on the primary, if the borrower puts less than 10% down, then the maximum, primary or second home, the maximum seller contribution, it can go up to 3%. It cannot be more than that. If the seller is actually giving more than that, either that money cannot be reflected, of course, on the final closing disclosure, or they can be an agreement where the difference can actually bring the sales price, so the buyer doesn't lose that money. Otherwise, we cannot put it on the closing disclosure. The maximum is only going to be 3%. If the buyer is buying a primary and second home and they're only putting 10% down. If the borrower decides to put more than 10%, which is 10.001, then they can go up from 3 to 6%. And then 9% if the borrower puts 25% down. And investment property, it's different. So it only can go up to 2%. It doesn't matter what's the down payment that you put or the borrower puts. It doesn't matter, an investment goes, it capped up to 2%. You cannot, the seller or realtors cannot give you more than 2%. So do you have any questions so far for us? No questions? Okay, so that was like the main difference between one and the other ones. Now the documentation also varies. FHA, depending on the program, if it's a manual FHA, they're gonna be more strict as far as documentation goes. Conventional, no, not as much. So each program has their own guidelines as far as the documentation goes. Also, one of the things that I wanted to mention is that on the gift letter, so let's say you're gonna be getting a gift from somebody, it has to be documented, which means that there's gonna be a gift letter that must be signed by the donor, whoever your family member is, and it needs to also be signed by you. And actually the gift letter is just saying that there's not gonna be a loan or a payment that there's going to be given to the donor after closing. The lender wants to make sure that there's not a loan, because if it's a loan, then it's not going to be that's not a gift. That's actually a loan, which we will have to document as part of your monthly debts, and that actually can change your DTI depending on how high is your DTI. You can get denied. So that gift letter is actually produced on our system, and we can go ahead and send that over. And again, it has to have the donor's information, name, address, phone number, and the relationship that you have between the borrower and the donor. We also have to have the donor's bank statement showing the funds coming from the donor's account and going into the borrower's account. They require 30 days. Now, one of the things to make sure you are aware of is that hopefully the donor is not giving you $20,000 today and yesterday they deposited that into their account. That's not going to be good. It doesn't look good, because what the lender is trying to do is to track where all the funds come from. And if you're giving $20,000 today and yesterday you deposited that money, that's a red flag, and they're going to ask for it. So 30 days for the donor, we have to document going into the donor's account, or sometimes it can be an exception where the donor can transfer the funds directly to the title company. But you do have to talk to, of course, your lender, your loan officer, before anything gets done, so they can guide you through the process and make sure that everything gets done properly and there's not going to be anything, any surprises at the end. We don't want that for sure. Okay, so that's really the main things. Now, the other item that we wanted to talk is about giving you some tips on what we do on our office in regards to making sure we keep in touch with our realtors or family members or people that can actually make our environment or our job or help us to be able to be successful in our career. So that's the next step. So we can, if you need a PowerPoint for this presentation, we can go ahead and send you the PowerPoint. I believe at the end it's gonna have my contact information in there. And then you can email us, and then we can go ahead and send you that. And also we can send you a sheet that we have that shows where you can put all the contact information or people that you should be talking to help you grow your business. So one of the things that we do here at Cross Country Mortgage is that every day we do something different. So let's say for Mondays, we have decided to call 12 different persons or 30 or a number. We set up a number, and then we make sure we get in contact with them, either family members, or it can be our friends, or it can be somebody that you're very close with, very, very close with. We just call them, we tell them, hey, how are you doing? Make sure that they know us. They know us. They can. If there's somebody says, oh, we're looking for a house or we're looking for financing, they can remember us. They're gonna be, oh, I know this person that can help you. So it's just the same with realtors. Good thing is to call everybody that you know, your family, friends, somebody that you always talk to, or you get to know them more, and then just talk to them and see how they're doing. We also try to do at least one launch a week, which means that we have that main person that is generated business. Let's say in our case, it will be a realtor. So we'll go and talk to the realtor, we'll take them to lunch, and we'll talk to see how their business is doing, maybe give them some information about everything that changed. It's just a touch that you can get very close to another person. And it does help. Sometimes it's not the first time, sometimes it's not the second time, but with time, they get to know you. Now, the third one is the birthdays. So we have, because of the programs that we do and everything, we have to put everything, of course, for the buyers there's social date of birth and stuff like that. So we always have the ability to pull up the buyer's information or stuff like that, and we always make sure that we have their date of birth. So when it's their date of birth, we get a notification. Actually, it gets sent out automatically, which we don't really have to do, but it gets sent out to the buyer telling them happy birthday, and then we can just follow up with a, let's say, a phone call. We tell them, hey, how was your birthday, and stuff like that. So it's a very special touch, and it does help. It makes them, of course, you're gonna feel special if somebody gives you a call on your birthday. You can also do gift cards. We'll do the emails. You can do gift cards. You can do, maybe send them food or take them to lunch just like before, it depends, or a little gift. And then what we also do, which is the item number 4, we send videos. Like this one, it's more for class and everything, but we can send a short video of what has changed during this time. For example, right now on student loans, it changed the minimum required payment now. It was before 1% of the balance, now we can use 0.5. And not everybody knows that, so sometimes little videos like that, it helps realtors to know, or maybe the client that didn't qualify because of the student loan, the 1% was higher. Now when we count the 0.5 is less, then they can qualify. Or at least we can look at the whole picture again and see where they stand. And then another item that we do is gonna be the happy hour. We do that every month. A lot of people that we invite, they do like that. So it's something different, a different environment. You can also do that with your clients, or just get to know them on a Friday and see what's going on around. So those are the things. So we can send, again, a copy of a document that we have, and you can put all their contact information, and I have that as well on the document. And then the last thing, I think I didn't mention this at the beginning of the class, but the last thing that we're going to be talking is about a program or a system that we have implemented in our company that actually helps a lot of people to be able to gain or have advantage of when offering or doing the offer with the listing agent, which is called Fast Track. So I'm gonna get more in details with that. So right now, because of the market, if you go into a listing, you're gonna see a lot of people putting only cash, cash, cash. No, they don't wanna do financing, because either financing takes more time, or the file goes, they think they signed the contract, but something happens and they don't get approved. So time is money. So they rather do cash than just going with somebody that is gonna be financing. So what this program has, it's helping a lot. It's actually being able to get our buyers, or the person who is trying to buy a house, because not everybody has all that money to buy a house. Or maybe they don't want to use it. They have it, but they don't want to use it. So what we do, we approve them or pre-approve them, probably approve them, it's the better word, beforehand. So we get all their documents, we do the pre-approval just like we do normally. We look at the credit, we look at their income, we look at their assets. But we also send all that file or all that information over to the specialist or the underwriter, who is actually the ones that approves or gives the final approval. And we do that beforehand. So what we're gonna be doing, clearing conditions, we make sure that they get approved for, of course, what they can qualify for the most. And then once we have that commitment letter from the underwriter, and hopefully with not conditions, then we can go ahead and present it to the realtors, and then the realtors can present it with their offers at the listing agent. So now you're gonna be calling the agent, or if you provide, let's say, the listing agent contact information directly to us, we can go ahead and call the listing agent to make the offer stronger. And we can tell the listing agent, yes, the buyer has their credit is acceptable, their income is acceptable, they do have the funds, we already sourced where the funds are coming from, everything has been clear. The only item that we need the borrower to be able to finish the transaction or close their purchase is gonna be the property, of course, very important, because you can't close without property. We need the property so we can do the appraisal, and then the borrower can go ahead and get the quote for the homeowner's insurance. And then, yeah, we can close after that. Of course, the title company, because not the title company, but the title paperwork, the title commitment, stuff like that. It varies from property, and the title company needs to do their search on their end, make sure that there's no liens and stuff like that. But the program actually helps to make sure that the buyer, is actually approved. They're okay. The only thing pending, outstanding, is the property and the documents, the title documents, and that will be everything. Once we get that, we can go ahead and close. So that's why it makes it way stronger, instead of putting on the contract that that they don't have that approval, that commitment, because there's a lot of things. So that really helps, and we can go ahead and do that on the loans that you, of course, you send us and stuff like that. And again, you send us the listing agent contact information. We'll give them a call. We'll tell them, you know, the information that not everything can be disclosed, of course, but we can reinforce that offer letter, and it helps tremendously. Sometimes it actually, that call that we make is the one that makes a difference from an offer, from a higher offer, just because they see the interest from the loan officer, and that we're being professional. So far, do you guys have any questions? No questions? Okay. So I think that will be all. In case that you guys do have any questions, just let us know, and we'll go ahead and send you the information or the answer, or we can also share the PowerPoint with you guys. Do you have any questions for me? No? Yep. And that will be all. Thank you so much. Have a great day. De nada.